It's amazing at just a slight change in your vernacular over a Q&A session can have that drastic of an effect on interest rates. And that's exactly what we saw today. What's going on, y'all? My name is Kevin Weedmark, aka The Mortgage Mouth, coming to you with another episode of the Daily Dose. Make sure you hit that subscription button so you never miss a beat. And that's exactly what we got today. You know, heading into the week, I said today was one of the top 3 things that I thought could potentially move the market. And as a matter of fact, I thought it was numero uno because it was early in the week. And that was Fed Chairman Powell speaking. Yes, we had several Fed members speaking this week, but nobody is more important than the Fed chairman when he speaks. And after last week where he got a lot more hawkish and we saw traders not like that vernacular so much and we saw a sell-off, especially after the initial jobless claims number on Thursday. Today, he backed off of that hawkishness, got a little more dovish in his vernacular in the Q&A, and that sent rates down. And that's a great thing, right? The market right now is just highly anticipating what the Fed is going to do because remember, once again, they are forward thinking. So anytime Fed Chairman Powell is going to speak or anytime we have big data sets come out, it is going to be something that can drastically move markets. And with Friday, we have inflation. Now, could that be something that's also going to drive the market later this week? Absolutely. I think the Fed's in a very precarious situation. They're trying to determine how lagging the labor indication is of how sluggish the economy is going to be, but we still have consumer spending setting record levels. But inflation is just sticky. And if it continues to rise, if it continues to increase, you can bet that the Fed is going to have to change their position. And although they would love to be giving us 2 more rate cuts this year, they may have to back off of that, especially if inflation continues to increase. You're looking at now, the Fed has told us over and over again that their target is 2%, their dual mandate. Is 3% really becoming the new norm? Are they going to have to change their basically goal and their outlook for inflation to become more accustomed with the 3% range so that they can make the case for bringing that Fed funds rate down to protect the labor market, even though we're sitting at inflation at 3%? It seems to have worked this last one Fed meeting, and it seems like the traders are expecting the same for the next 2. It's going to be interesting to see, but the main thing is, hey, it's going to be dependent on that data. All right, y'all, have a good evening. I'll be coming to you tomorrow with another episode of the Daily Dose. Cheers.